Hey class, welcome to chapter one, where we'll be discussing chapter one of investments. Backgrounds and issues are really the key framework of the chapter. Some of the things on a high level that we'll be discussing today include real assets, and then how do you differentiate those between financial assets. Uh, Competition in financial markets can lead to risk and return trade-offs. And where does money flow? Imagine where we are in the economy right now where risks seem high. Some people are going to flee to stocks like General Mills, a cereal maker, and other people will flee to high risk names like Tesla. And that's what helps create a dynamic market. Financial intermediaries will be discussed, and those are related to groups that aggregate assets. So one way to think about that would be mutual funds and ETF companies. We will also discuss investment banking, and what that is. They basically help firms fundraise. I don't want to compare them to a real estate agent, but they help sell a part of ownership, and they get a percentage of the deal. If you're going public and you're a $2 billion company, getting 1% of that deal is a ton of money. So we'll also review the financial crisis and the lingering impacts of that. So we're going to switch now to the slides. Hope everyone's having a great day today. So chapter one, again, background and issues. First, nature of investment. Reduce current consumption for greater future consumption. Kind of like savings, putting money into your 401k. What is the purpose of it? To not touch it for a long time and have it be used in a later date when you may not want to work. So financial assets, the claims on real assets or real asset income. So real assets can have productive capacity. Think about a factory. Property, plant, equipment, cars, trucks, all that stuff, all that can be considered part of productive capital and real assets. This is just a quick example of a balance sheet of the U.S. household. And what they're saying is that 24%-ish of U.S. households worth is as real estate, and about half of that real estate appears to be mortgaged. So you see that on the right side where you have the 13% under mortgages, and the real estate's about 23%. So most people own about half of their home. Financial assets can also equal financial liabilities. Thus, when all the balance sheets are aggregated, only real assets remain, which is net worth, right? What you own minus what you owe is your net worth. And again, this is just showing domestic net worth in 2014. I don't try to pay too much attention to these slides because they get out of date pretty quickly and they don't really tell too much of a story. So financial assets also can include common stock, derivative securities. Think about options. I know right now, currently, and I don't advise this, Robinhood is very popular for options investing. And there's also fixed income securities. Many investors, the professional ones, when they want to get safe, they'll move from stocks down to bonds before moving to cash or gold. So bonds is traditionally a pretty safe asset class. Financial markets in the economy, information role of the financial markets. Financial markets provide information. Why does a stock go up? Apple stock has been pretty durable for a number of years. And why is that? Well, it's because we can have some clarity into the future cash flows of Apple, their future profits, their business. We know about how many iPhones they're going to sell. It's really now a question when you're looking at Apple's worth, just as an example of what other funds are they going to bring in through their cloud business, their music business, things of that nature. Again, it asks, do market prices equal the fair value estimates of the security's expected future risky cash flows? I know I brought up Tesla a few times, but again, I wanted to make this class timely. I read an article this morning in the Financial Times that indicated that Tesla would have to have 10 years of perfect growth and more profits than any other auto company out there, and more efficient than Toyota, the most efficient automaker in the world at the moment. So that's how you could justify. And even the article said, even then, if they were priced to perfection for 10 years, it still looks expensive. So sometimes the markets can go out of whack from the prices, or maybe something miraculous happens and they actually, pull it off financially. But again, one thing I'd caution on Tesla is as soon as their stock price went up, Tesla sold more of its stock on the public market. If they thought it was such a good price, why would they be selling it? And some of it is that they need more assets to build. And the idea right now, the bulls will say, is that the easy capital that's cheap will enable them to grow quickly. But again, that's up for debate. And then can we rely on the markets to allocate capital to best uses? What do you choose to invest in, right? How does society choose to invest? Is the market always right? Generally, if you're a business manager and you're deciding between two products, you're going to look at the cost and the return that's projected of that project, and then put more money into the area that appears to be most effective. Consumption timing. Consumption smooths over time, but there'll be periods of time where people go into heavy spending. Look back in 2018 and 2019, spending was pretty high. But you go back to the last 3 months, spending dropped. Savings actually increased for a lot of people because of the federal and state stimulus that was offered. So there's a normal level of consumption, that average. That average is really hard to hit over time. Usually we're above it or below it, and that's how we get that average. Risk allocation. Investors can choose desired risk level, stocks versus bonds, or bank CDs versus a bond. Is there always a risk return trade-off? Absolutely. Well, if you're investing in a very risky drug stock, that's like a binary event. And what's a binary event? Like either it goes way up or it goes to zero. But within stocks, like I mentioned, you have stuff like that's safer, like a CVS or a General Mills. And I just say safer as in there's less volatility in prices. The volatility in prices is generally smaller with names like that. And then there's riskier stocks like Amazon and Google and biotech stocks. A step down from that would be the bond market. So if someone wants to maybe, historically the bond market probably has gotten you about 3 or 4% a year. Maybe a little bit higher depending on the type of bonds, because you can actually find bonds that are risky that earn you a higher interest rate. But the price of being wrong on a high interest bond is that they go bankrupt and they don't pay you back. But generally, if you're investing in high quality bonds, it's just a function of you getting paid back. And then kind of lowest on the risk level is bank CDs. That's like a bank deposit. You don't get much money on that, in this environment, somewhere between, the bank deposits 0 to 1.5% maybe. So, that can be a challenge. Where do you want to keep your money? How much do you want it to have potentially earn? Separation of ownership and management. Large size of firms require separate principals and agents, meaning the owner and the management are generally different parties in big organizations. And as you may have seen in life, the management's incentives can vary from the owner's incentives, right? Separation and agency problems. So, those are mitigating factors. How can you keep, well, let's use a simple example. If you're the owner of the restaurant, and your friends come in and you comp them a meal, that you're aware of the cost to that. It actually comes out of your pocket as the owner. But if you're a manager and your friends come in, right, it's really not in the owner's best interest to be comping the meals of the manager's friends, because he's basically giving away the owner's money, right? He's giving, and the owner might not have chosen to do that. It's policy specific to the organization, of course, but that's just one example of where the management can act outside the best interest of the owner. But if you give the management a percentage of profits, or for a small piece of ownership, they may be less likely to engage in those types of behaviors. And again, here is an example of an agency problem. In February 2008, Microsoft offered to buy Yahoo at 31 per share. Yahoo rejected the offer. They had a fight and seized control of the board, which failed, and the stock went down. So, effectively, when Microsoft said they were interested in Yahoo, it went up, but Yahoo didn't want to be bought out. They didn't want someone else taking them over. And that actually hurt the value of the company. And the market was saying, really, we think Yahoo is in better hands with Microsoft than it is on its own. But the owners or the board who, have an interest, if they leave, Microsoft buys them out, they're out of the job. So, it's maybe not in their personal best interest to be bought out. And, if we look at Yahoo today, it certainly has not lived up to expectations. Corporate governance and ethics. Business and markets require trust to operate efficiently. Without trust, additional laws and regulations are required. Laws and regulations are costly. So that's a good summary there. Couldn't say it better myself, in my own words. Governance and ethics failures cost the economy billions, if not trillions, and erodes public support and confidence. A few years back, Wells Fargo was accused and convicted of effectively ripping off their customers and opening fake accounts. Now they're under heavy scrutiny for many years to come, likely. There's also been accounting scandals like at Enron and WorldCom, misleading research reports, and also research reports are not always perfect. They can have flaws. The opinion of a research analyst can be wrong. When you hear Warren Buffett say something or an analyst from Goldman Sachs, that usually has an air of approval to it, but just because they're from a high quality organization or a great thinker does not mean they're always right. Sarbanes-Oxley Act requires more independent directors on the board. It requires a CFO to personally verify the financial statements. Before the Sarbanes-Oxley Act, which was enacted after the Enron collapse, the CFO could be like, oh, well, it wasn't my fault. I didn't know that the people beneath me were committing fraud, right? He could claim blindness, and that's no longer the case. Asset allocation is the primary determinant of a portfolio's returns. Asset allocation is really, how much do you want to allocate into risk and how much do you want to allocate to stuff that's less risky? So right here, you see on the left, a typical 60-40 bond portfolio. And then on the right, that's more of a 25% in equities, and the rest is pretty conservative. Security selection, that's where I was talking about a few minutes ago when I mentioned within risk, you can pick securities. Do you want to buy big stocks like the S&P 500 largest stocks in the US, or do you want to buy small stocks like the Russell 2000, which is a 2,000 smallest stocks in the US? Read in the Financial Times today that the value of Apple is now higher than the Russell 2000 in its entirety. So the value of Apple is now bigger than the entire Russell 2000. So, the problem with big companies like Apple versus small companies is that in theory, the law of large numbers eventually kicks in and Apple cannot continue to grow at that pace. One of my favorite quotes is, trees don't grow to the moon. So, once the law of large numbers kicks in, eventually it becomes harder to grow. But that remains to be seen. There can be different types of security analysis. So bottom-up investing is the opposite, where you're just picking the individual companies and you're starting at that level, instead of starting at the top and looking at the economy. So, there's different ways to skin a cat when it comes to investing. Assets with a higher expected return have higher risk. If you invest in a stock that goes up a lot and went up quickly, you can also have a high probability that it could go down just as quickly. So that's obviously a concern. Stock portfolios lose money 1 out of every 4 years on average. So think about that. 1 out of every 4 years, you're going to have a negative portfolio, right? And people don't like looking at negative numbers. And that can lead to other biases within investing. Bonds have a lower average rate of return. It says here under 6, but for quite a few years, and I can't imagine for quite a few years more, we won't see bonds with a anywhere close to a 6% return. I kind of expect 3 or 4% in this environment. But bonds have not lost more than 13% of their value in any one year. So, considering the stock market can crash, in the high mid double digits, bonds typically don't lose that much. How do we measure risk, and how does diversification affect risk? Well, let's phrase that. Let's start with the bottom up here and say, how does diversification affect risk? Diversification decreases risk if you're properly diversified. So, if you have someone who owns a lot of Apple and Amazon stock, they own a lot of technology. So you want to buy assets to diversify them that are away from technology. So think about healthcare stocks, consumer staples, like Constellation Brands, that's the maker of Corona beer, or General Mills or CVS. Those would be on the other side. That's a little bit more safer and not as concentrated in the technology companies that you want to move away from. And then how do you measure risk? Well, I look at risk as, the market looks at risk as effectively price volatility. How much does this asset move in value, right? So bonds don't give you a lot of return, but they don't move a lot in value. Cash moves very little in value, but stocks can move very heavily in value. In efficient markets, securities should never be over or underpriced and reflect all information available to investors. This is the efficient market hypothesis. Your belief in market efficiency will actually impact your investment style. If you believe the market's efficient, then going passive and just buying a low-cost ETF will work for you. I personally, in recent years, have been doing a lot more stock investing, and that's just a function of my clients. Active management believes the markets are inefficient, that actively seeking undervalued stocks is appropriate, and that you can time the market. Passive management believes markets are efficient. It's not worth it from a cost perspective to find undervalued securities, and there's no attempt to time the market. You just go in. The players, business firms, they're net borrowers. Households, they're net savers. Governments can be both borrowers and savers. Intermediaries can be connectors of borrowers and lenders. That includes commercial banks, investment companies, insurance companies, pension funds, and hedge funds. So starting with the latter three, most people are less familiar with that. Insurance companies do a ton of investing. They take the money that you give them for the premiums, and they don't make money off of the money you send them. They take your money and then they invest it. That's how insurance companies make money, not from collecting the premiums, generally speaking. Pension funds, if you think about like the Massachusetts Teachers Retirement System, they have a lot of money aggregated. So they are someone's very big client, right? And then hedge funds, those are large pools of money for sophisticated investors. I say sophisticated. Hedge funds, it's really they use the amount of money you have as a definition for sophistication, meaning if you have $5 million, you can invest in a hedge fund because you can afford to lose it. They are liberalizing those laws, but for now, it still is pretty rigid. Sophistication is measured by dollar values. Investment bankers, firms that specialize in primary market transactions. Primary market transactions are bringing a company public. Secondary market transactions are you and I buying and selling stocks. Primary market is going public, and that just happens once. Well, it happens once, but companies can go out to the market multiple times. When a company goes public, they usually don't sell the entire company on the stock market. They'll sell like 10% of the company on the stock market. The reason they do that is that the ownership wants to retain control, but they want to raise money. And if they only sell 10% of the stock on the market, the owner, even if every one of that 10% won some kind of change, they'd have really no voting power, right? Because insider parties effectively own the majority of the stock. Investment bankers, commercial investment bankers functions in organizations separated by law, 1933 to 1999. Post 1999, large investment banks are independent from commercial banks. This is a little bit of ancient history here, guys. But they separate the banking activities from the investment banking activities in order to kind of effectively prevent corruption and fraud. Investment banks may become commercial banks if they get deposit funding and they can have access to government assistance. Again, this is a little bit more nuanced than I usually like to go over, but it is part of the course and part of the slides. Major banks are now under stricter regulation because of the financial crisis. And this is, again, a balance sheet of all commercial banks in 2014. You can see 75% of their liabilities are deposits. Deposits are actually a liability for banks because they have to give that back to you. It's not their money, it's your money. So a deposit for a bank is a liability. There's also venture capital and private equity. Those are firms that can go out into the market and see a good business and invest in it, or see a good business that's public and take it private. That happened with Dunkin' Donuts at least once in the last 10 years, where they were public, they were taken private, and then they were brought out public again. And one of the reasons for this is that there is a belief that if you take a company private, you can make change easier because you're under so much scrutiny in the public markets that the private markets tend to be more favorable for change. The same thing happened with Dell Computers at one point. And then venture capital is more related to investing in like risky startups. Changes in housing finance, low interest rates and stable economy created the housing market to boom. One of the similarities I think right now because of coronavirus is, we have really low interest rates again, and that could actually create another housing boom. And don't think that means a real estate crisis. There can be a boom and things could stabilize or normalize over time, but the low interest rate environment we're in again will be supportive of real estate. Subprime loans are just basically people with bad credit or subpar credit. They are charged higher rates, and those are riskier loans. Like anything else, if you're higher risk, just like on the personal side, you get charged a higher interest rate to reflect that risk. And this is housing prices, from 1990 through 2014. And, I believe that the housing prices are actually quite a bit higher than they were in their peak in 09, where we are today. So interesting dynamics, continue to kind of come forward in the housing market. And again, depending how low rates stay, because why do low rates support housing? I'll answer that question for you guys as well. One reason low rates, support housing is really because people don't buy houses based on the price. They base it on the monthly payment. And the low interest rates, compared to a year ago, early 2019, a $500,000 home is about, I would say 25% cheaper than it was a year and a half ago because interest rates have went down so significantly. So, that is something to consider when looking at, the housing market and interest rates. So, hopefully that's helpful for you guys. And I'm killing time for a second because the slides have stalled on me, but I have another backup here, so we can switch to that. Give me 1 second here. Feel free to, write me a message about anything you're interested in investing that you might want me to cover. And I'd be happy to chat with you about that as well. All right. Here we go, we're back up. Geez, it's gonna make me go through all these, huh? All right, we'll go to systemic risk here. Risk of a breakdown of the financial system. So the entire system. Most companies, there's company-specific risk. But systemic risk is the entire system. Excuse me. Banks were highly levered, meaning they didn't have money to give to people. They didn't have a lot of cash on hand, and they owed a lot of money to a lot of people, just like people did. Formal exchange trading replaced by over-the-counter markets. No margin for insolvency protection. When you have all your assets loaned out, and your customers have loaned everything out, and you need to pay a bill, you don't have easy access to cash, which can be a real challenge. And the shoe dropped in 2008. Fannie and Freddie Mac were put into conservatorship, meaning that those were government mortgage groups that were semi-autonomous, and they were taken under full custody of the government. Lehman Brothers and Merrill Lynch verged on bankruptcy, and effectively the federal government the Fed had to get involved to support the economy. Dodd-Frank Reform Act called for stricter rules on bank capital, liquidity management, and risk management. One of the biggest change personally that you've seen is that, in 2005, you could buy a home with no money down. And now I think you need a minimum of about 3.5% to buy something. This is the interest rate, one measure of rates over the last, 20 or so years. And you've seen, since 07, 08, and it's continued, we've been in an environment of low interest rates. Many fear that low interest rates for a long time will lead to hyperinflation. Because of technology, though, driving costs down, we haven't seen inflation as we traditionally have in the past. And this is a return of the S&P 500 over time. So if you have $1 invested in 1980, you've made more than $50 on that $1. So if you can ignore those massive ups and downs, you can certainly do pretty well in the market. One of the issues, though, as we see here is, sometimes those downdrafts, are multi-year events, and the market can go down, 50%. So, don't be surprised when it happens. You just have to be able to stomach it for the most part and ignore it. And that's sometimes the most challenging thing in investing, is to do nothing. And again, this just wraps up the chapter. So great speaking with you guys. Looking forward to chatting more, and have a great day.